Romain, let me start with you, just to get a kind of internal perspective on what is happening here. Yesterday afternoon felt like a bit of a capitulation moment. Everybody's looking forward to the long weekend. President's Day Monday. You've got a lot of geopolitical risk that you've got to manage. The market's incredibly whippy. I look at Roku today, look at DraftKings today. Time to check out, time to go home, time to take that position off.
Yeah, and you definitely saw that in some of the volumes, really, not just yesterday, but going back to Monday, Tuesday, Wednesday here. Those volumes continue to come down, not only on an aggregate basis, but on a single stock basis, you've seen them come down. At the same time, when you look at the activity in the options markets and how many people are gravitating towards put options, basically some protection to the downside, you do get that sense that people are willing to just walk away, maybe wait to see what develops with regards to Russia, Ukraine, and more importantly, Guy, to see what develops with regards to inflation and the Fed.
So, Cameron, after a dip like we saw yesterday, would you be comfortable buying it into the long weekend?
Well, I think you have to be very selective in what dips you buy. And this is where trend work becomes extremely important. We're willing to buy dips in areas where we're seeing oversold conditions and uptrends on both a relative and an absolute basis. But if you're talking about names that have been in downtrends, and a lot of these fall into that speculative tech area, if you're starting to see bounces, we would really be more inclined to sell those rallies. And so be very careful about the trends. You can buy oversold uptrends, but then you really want to be selling rallies in downtrends.
We talk about managing risk, Cameron, around a long weekend, but as we've just been discussing, there's a lot of kind of unquantifiable factors around at the moment. So maybe a lot of people are just stepping back more broadly from the market. And that kind of brings me on to some of the individual stock price action that we're seeing. On my screen at the moment, headlines: DraftKings sinks drinks. Maybe I've got the weekend on the mind already. 15% at the open, and the biggest drop since March 2020. Roku drops 27% at the open, biggest decline on record. These headlines keep coming thick and fast. Individual stocks, even if they're missing or beating by tiny amounts, are getting whipsawed by this market. How on earth, as an investor, I'm not talking about as a trader, how as an investor do you deal with that?
I think you have to realize two things. The first one is that a lot of these individual stocks that are getting hit hard right now were the mecca of the really big, long YOLO option trading. And so it's one of the reasons why we can see such whippy trading, because those options positions are getting unwound. But the other thing that's important is that we think that investors need to be very appreciative of the fact that the liquidity environment is going to continue to tighten. And so as that tightens, there really isn't any appetite for high valuation kinds of names. So where you can reduce exposure to areas that are dependent on liquidity, you simply have to, and then rotate into more defensive areas of the market, whether it's in consumer staples or in utilities, as well as in some of those defense areas. We think that's a really cheap way to hedge out some of this geopolitical risk, mostly going into really big headlines. And so these parts of the market have been left for dead for much of the past rally over the past couple of years. So that's a fantastic opportunity to be able to add some little bit of safety within portfolios.
Romain, I'm looking at the move for Roku. I'm listening to what Guy just said, and it reminds me that earnings season is still going on. We've been focused so much on these big macro issues of geopolitical risk, of Fed policy, inflation. Where has earnings season left us, especially when we look forward into the outlooks for the rest of the year?
Well, if you look at the micro, before we sort of got consumed by the macro, it actually wasn't that bad. I mean, most of the earnings that we got, at least for the fourth quarter, for that final quarter of the year, were relatively in line to above expectations. The bigger issue was with guidance.
Right.
A lot of the guidance not only disappointed, some companies just refused to even give long-term guidance because of the uncertainty around there. And to Cameron's point about the liquidity in this market right now, this is going to become a much more of a bigger factor here with regards to what gets bought and, more importantly, what gets sold. This is just not the same liquidity environment that we were in, Guy, a year and a half ago.
Well, and let's just talk about what is happening, particularly with the options trade and what is happening there. These names, even on relatively short-dated calls or puts, the premium has gone up really quite significantly. How much of what we're seeing, particularly when some of these moves get going, is just basically the gamma trade, both up and down? Because it feels like everything's getting pushed around much more than it normally would have done.
Yeah.
And with those big premiums, that kind of makes sense.
Oh, it's huge. I mean, the short gamma right now it's definitely going to drive today with the option expiry for the month here, and that's going to be a huge driver, particularly as we get closer to the closing bells here in New York. We've already heard from a lot of folks based on Bloomberg reporting. A lot of traders and dealers have basically said that a lot of these dealers have to follow that trade lower, basically where we were yesterday. So we could see more selling pressure based on that. I guess the question is, what type of trades then get sort of reset when we come back to work on Tuesday here in the United States after the holiday, and whether some of those sold off names have to then be bought back?
Well, and obviously, Cameron, it's a holiday here in the U.S. It's not a holiday elsewhere. And that brings me to kind of how the U.S. market is stacking up relative to the rest of the world. Given the heavy growth exposure, which obviously has come under pressure due to higher rates, is the U.S. equity market going to be able to hang in there?
That's a fantastic question, because we are just now starting to see better relative performance for non-US markets, really for the first time in 5 years. And if we zoom out, we can see that international markets, whether it's developed or emerging markets, have been in very, very strong downtrends for much of the past 15 years. So we haven't seen a breakout in those relative trends to really argue that we should be moving to big, huge overweights in international and EM. But we do see that on shorter term trends, things are starting to look a lot better. And that is consistent with exactly what you said. These markets tend to be more value oriented, cyclical, old economy, don't have as much growth exposure. And that's helpful in this tighter liquidity environment. There's one last point that investors do need to be careful about, is that these markets do tend to be higher beta or higher risk, meaning that if we see a big risk off move in markets, investors are likely to dump these areas that do have more volatility over time. And so you have to be quite careful, choose your positions really carefully, but noting that this is kind of the first signs of life in international that we've seen in years.
Can I just take you back to that beta position and the fact that we could see volatility? Cameron, how are you thinking about hedges right now in the portfolio? What is acting as the dampener in your portfolios and the way that you're thinking about the way that strategy should work here?
So that's a great point, because we actually are starting to see some traditional hedges within portfolios for big kind of spikes in volatility start to perk up. So that includes things like gold. So gold has been performing a lot better despite the fact that we've seen real yields move higher. That's really interesting, because gold and real yields have been inversely correlated for much of the past 10 years. And so that could be a signal that there's some increasing demand for gold. And if we look at things like CFTC's positioning in gold futures, it remains kind of middling. So that's supportive of another move higher in gold as well. So that is the commodity portion of the hedging of the portfolios. And as I mentioned earlier, something that looks like more consumer staples, utilities, that kind of late cycle risk off benefiting types of areas are starting to see better relative trends. So we'd use spots like that in order to add some defense into portfolios and provide some downside protection.
Cameron, this situation for Deere, how sustainable is it right now? Joe making the point that the demand is absolutely off the charts right now. Is that something that continues? Do people just keep buying, do farmers just keep buying tractors and combines and whatever else they need as long as ag prices remain as high as they are?
That is the big question for investors from here, because it's how long does this ag cycle last? Ag cycles don't end when farmers can't get their hands on equipment, when they don't have enough equipment. Ag cycles end when they have too much equipment and they don't need to buy anymore. And so we see plenty of signs that Deere isn't able to keep up with demand. They're not able to build inventory. They're only producing to end retail demand despite going full tilt. They'd like to build inventory. Farm machine age is kind of on the older end. We're also seeing big, huge jumps in used tractor pricing. They increased almost 30% last year. All of that is indicative of still really robust demand for tractors and other farm equipment. But we have to watch farmer profitability really closely. So we are seeing crop prices go up. That's great for farmer incomes, but we're also seeing all the other input costs go up. So farmers have labor issues, seed prices are going up, fertilizer fertilizer prices were up almost 175% since pre-pandemic. That's actually good news for Deere because Deere makes farmers more efficient. It allows them to do more with less, which is why demand remains so robust. And likely, if we do see a down cycle, if prices for crop prices come off, it likely means that it's fairly shallow because farmers need this equipment in order to get the output at a very reasonable cost as much as they can.
Well, taking it beyond Deere and just the broader agricultural landscape, Cameron, obviously there is a lot of crops that are coming out of Russia and Ukraine, that region in particular, where a lot of this geopolitical tension is centered. How do you view that risk?
So Russia and Ukraine are both major producers and exporters of wheat. Wheat's up about 8% starting this year. So it does appear that there's some kind of geopolitical risk premium being factored into wheat. There's a lot of exports that still need to go out from last year's harvest for wheat, as well as the idea that we would need to see imports of things like fertilizer and seeds into Russia and Ukraine. And that could get disrupted if we see an escalation in this conflict. Now, it's important to remember, though, as we go into the G7 meeting this weekend, that it's very unlikely that global leaders will want to go after some kind of embargo that could affect food prices. That's because food prices are at 10-year highs. They're up almost 50% since the pandemic lows. And they're at highs not seen since 2011, which was during the Arab Spring. So it really would be a Pyrrhic victory for global leaders to impact food supplies in any way.